Good morning. I'm Andrew. I'm the Communications Director here at the New Hampshire Insurance Department. I'm joined by my colleagues, Christian Citarella, the Chief Property and Casualty Actuary, and our Deputy Commissioner, Keith Nyhan. Appreciate you joining us for another episode in our series aimed towards consumers and legislators. This one will joining us is about how insurance is priced. So I'd like to introduce, to get us started, our Deputy Commissioner, Keith Nyhan.
Thank you very much, Andrew, and welcome everybody. On behalf of Commissioner Betancourt, I want to thank everybody for attending today. The department is very excited about the series of webinars and informational sessions that we've been promoting. We are very excited to have Christian Citarella join us today as our Chief Property and Casualty Actuary. And today we're going to focus on really the complexities of how insurance is priced and what the impact is to New Hampshire's residents. And finally, we're going to touch upon a couple of key points of what consumers can do to help themselves in these times where we do see pressures on premiums. And with that, I'm going to turn it over to Christian Citarella. And again, thank you very much for joining us.
Insurance is priced using a couple of principles, and this comes from the Casualty Actuarial Society, which is the professional organization for property and casualty actuaries. And I tend to use this slide whenever I'm presenting on actuarial activities, because this is what we actuaries kind of think, keep in the back of our minds. When we talk about a rate is an estimate of the expected value of future costs. A rate provides for all costs associated with the transfer of risk, and ultimately that's what an insurance contract is. An insurance contract is an agreement between the purchaser of the contract, the insured, for a fee, for a premium, to pay a carrier, the insurance company, the protection against future claims, future losses. And so the rate provides for all costs associated with the transfer of risk. A rate provides for the costs associated with an individual risk transfer. And we talked a little bit more about that on a prior webinar activity about 6 months ago when we talked about different types of factors that go into the premium for an auto policy. And we can touch on that a little bit more if necessary later on. Ultimately, in the fourth principle, a rate is reasonable and not excessive, inadequate, or unfairly discriminatory if it is an actuarially sound estimate of the expected value of all future costs associated with an individual risk transfer. That language of not excessive, inadequate, or unfairly discriminatory ends up gets pulled into many of the laws that the states have written and passed to protect consumers against those very things: excessive, inadequate, or unfairly discriminatory rating practices among carriers. I highlight the second principle for this activity because I wanted to talk at some point, a little bit about all the different pieces that go into pricing an insurance product, pricing coverage, and there's more to it than just what is going to what those claims might be. And so we'll get into that. It's important to remember that insurance rate making or pricing of insurance is a prospective activity. In short, the seller, the insurance carrier, doesn't know at the time of the sale how much the product is going to cost. And often when I'm teaching this to students, or explaining this idea, I talk about how it's different from selling a car or selling a television in the sense that the product is complete at that time of sale. You've already built the television, and so the seller knows how much it cost to make that product. Where insurance, you're selling the product before the expenses to the carrier, to the seller, are realized. And so what the insurance company does, the insurance carrier, the seller, has to go and use past experience and patterns of change, also known as trend, to project the cost of the transfer of risk. They need to anticipate what the cost is going to be 6, 8, 10, 12 months down the road. And so that's where the real work comes in. There's quite a bit of uncertainty, and the more information that an insurance carrier has, the better off they are at adequately pricing the risk. And so what the insurance company wants to do is determine what's called a pure premium. The pure premium is the portion of that overall premium, that final premium that the customer pays. It's the pure premium is that portion of the premium that covers anticipated loss due to covered claims. Some carriers will include in that the adjustment expenses, those costs to the insurance carrier that go into assessing how much, who was at fault, like if there was a car crash or something like that, who was at fault, how much the insurance company is owes to fix the car or take care of any injuries or things like that. All of that adjustment expenses is often included in that pure premium calculation. So a pure premium is often is described as a rate, and that's why we end up talking about these ideas of rate and rate making, because the pure premium is a rate per exposure. And the exposure, how the exposure is measured depends on the type of coverage we're dealing with. So if we're talking about homeowners coverage, the exposure is one house for 1 year, or one house year is that exposure. For a car, again, similar, it's a car year. But if we're talking other types of coverages, you might get other types of exposures. So if we're talking, for example, in workers' compensation insurance, an exposure is often $100 of payroll, so things like that. So taking it back up to a higher level, a pure premium is simply looked at as a rate per exposure. And very basic calculation of pure premium is we need to estimate two quantities, two values. We need to anticipate or predict what the frequency is going to be, the likelihood that a loss is going to occur or a claim will be made against that policy. And we need to calculate, often separately with different techniques, the severity of that claim, that loss that may occur. And then that pure premium is simply the product of those two estimates. Frequency is measured as claims per exposure, and so oftentimes, the other way to think about it is the probability. And if you're dealing with a car, with auto insurance, what's the probability of having a crash or having an accident or having some other event that requires, your insurance to kick in, like whether that be like a weather event or something happening to your vehicle. And then severity, of course, is that cost of that claim. How much is that claim going to cost the insurance carrier? All right, so with those in mind, I thought what we would do next is look at, I thought about going back and just grabbing some recent prior data and look at kind of the auto market and see what sorts of things are really affecting the auto market and why we're seeing such an uptick in auto premiums of late. And when I started going to look at some of the information, I decided to go grab what's called the fast track data, and that's put out by ISO, the Insurance Services Organization. And it covers most of the market. There are some carriers that don't participate. But generally speaking, it's a very good database of recent premium and loss data. And so then I decided to start putting together some slides, and then I realized that we very recently, I think it was March 11th, we had Dr. Robert Hartwig come in and do a presentation, and it turns out his slides are a lot better than mine. So I'm going to go use his. This is all from Dr. Hartwig at University of South Carolina, and so this is his work using the same data that I was going to go. And we're going to look at data through Q3. So this is from Dr. Hartwig's presentation at our first annual, what was it called? It was called the first annual symposium, Property and Casualty Market Symposium, about 3 weeks ago. And what Dr. Hartwig presented is kind of an overview on where the frequency and severity of different pieces of the auto market were headed. And so in the first slide, we looked at the bodily injury liability portion, and we saw that the blue is the severity, the yellow is the frequency. You can see that the frequency is actually going up in the last couple of years. During COVID in 2020, 2021, frequency was way down. But severity is also going up, but recently it's taken a little dip in the very recent experience. I think that's going to change because with bodily injury, it's the only piece of the auto liability of the auto coverage and the auto experience that is what we say is going to develop over time. Injuries, you end up paying out claims a little bit later in time, and so I think this this number over here, this negative 3.2, is probably going to it's not going to stay negative as these claims develop. Now, here's the real picture. Here's the real story that's going on right here. And this deals with this is physical damage. This is property damage liability. And you can see that the severity has had significant upticks the last couple of years. Frequency dropped again during COVID. This parallels the bodily injury liability. There were fewer car crashes when folks weren't driving. Now that folks are back on the road, there are more incidents. But the cost to repair those vehicles, the cost to repair those vehicles is significantly higher. Similarly, when dealing with collision claims are damage to your vehicle, to the insured's vehicle, when there's a crash, when there's an accident. And here you'll see again that although the severity was way up in 2021, 2022, it hasn't been, it is starting to level off. It looks like it might be starting to level off a little bit, but this has been affected, as you've heard and read in the reports. Inflation has a really large effect on this because the parts are more expensive. Just getting the parts can be more complicated, and also labor. And finally, comprehensive severity is way up as well. Comprehensive is weather events that occur, or theft, things that are not related to car accidents per se. And comprehensive claims, the severity has been way up, and that too is greatly affected by market conditions. So just as a dollar value, this chart just shows from a dollar's perspective. These are collision claims, so this is repairs to the insured's vehicle, and you'll see that just in sheer numbers over, these are quarterly values over since first quarter of 2019, that it costs more to fix the cars than it used to. However, one positive is that it's not as bad as it is in other parts of the country. So this is New Hampshire collision claims severity relative to the U.S. as a whole. And we're a little bit below the average countrywide. Here, this is, okay, so this is important statistic to understand when understanding how much insurance costs and the premium that consumer is paying for their policy. And these are the loss costs. The loss ratio. The loss ratio is that pure premium we were talking about earlier as a percent of what is charged. Remember, there are other costs that go into an insurance policy, not just paying out the claims. And so the portion of the premium that is associated with loss creates your loss ratio. Generally speaking, for personal lines products, you need to keep that number if you're going to have an effective insurance company and it's going to stay afloat. Those numbers need to stay below 65, 60%. Different companies have different target rates that they go for. But you'll see over here, this 99% in quarter one of 2022 is completely unsustainable because there are other expenses. This does not account for things like marketing, things like overhead, things like corporate offices, and it is unsustainable. An insurance company with a 99% loss ratio is not going to stay in business very long, and then they won't have the available funds to cover claims. Now, luckily, we are seeing it kind of tick back down into a more reasonable number of late, but even so, this is I look at insurance companies with these numbers, and again, this is average across New Hampshire, but if I'm looking at these companies and I recognize that they're going to need to charge more for coverage going forward if they're going to be able to sustain the company. So these are this is countrywide loss ratios for collision. And again, you'll see these numbers, although they're not as high as they had been in 2022. So, and the way that's affected is that insurance companies, they take on more rate, meaning that they increase the premium in order to handle anticipated future losses. They're doing a little bit better, but this still indicates to me that they're simply not charging an adequate amount. And liability loss ratio, similar story. I will, though, remind you that this is more so for the property damage component rather than the bodily injury component of liability. But you'll see these loss ratios are still quite high. And I just want to talk a little bit about what the insurance company does with this information. So they go and they determine that, hey, our loss ratios are really high, we're out of control, and so then the insurance company will then submit a rate indication to our department with the proposal to increase what they're charging to consumers. And so in this situation, I'm going to switch over to homeowners now and give you an example of what that looks like and what kind of my task is when I see what the insurance companies propose. And so when looking at all this, an insurance company, like I said, they have other expenses that they need to take care of, other responsibilities, like I said, overhead, like marketing, like taxes and fees that they have to operate their business. And so what they determine is what's called a permissible loss ratio. And so that's the kind of that goal. What portion of the premium we charge do we need to have available, in order to pay out the claims? And then, as I mentioned, they have to take into account these other expenses: commissions, taxes, licenses, and fees, general expenses, acquisition expenses. That's the cost to them to kind of take on more policies. A big portion of that has to do with marketing, relationships with agents. If they're working with independent agents, they have to deal with commissions. And then, of course, an insurance company is a company. They have a responsibility to their shareholders, or if it's a mutual, they have a responsibility to their members to have a profit. And then there's also contingencies. Contingencies are always in play because, like I said, this is a prospective activity. No one really knows what's going to happen. And so they need to build in a little bit of a buffer in there to take on the volatility. So this next piece is really, really busy. But believe it or not, this is among the simpler exhibits when it comes to an indication. I have redacted. This is a publicly available document. As with all rate filings that come into our office, once the rates go into effect, then the public does have access to them. However, I did redact out the name of the insurance company because although I really liked the way they laid it out, some of the things I might say might come across as critical, and so I didn't want to disrespect this particular company. Generally speaking, everything in here is much easier to see and understand than in many other of these indications that I get. So this is what's called a rate indication, and this is submitted in support of an insurance company's rate filing. So their goal here is to change what they're charging for homeowners insurance for their book of business. And let's see, can I do this down here? So over here, if you can see the mouse, at the very bottom, this is their proposed rate change. So their proposal is to, generally speaking, increase everybody's homeowners policy in their book of business, all of their at renewals, to increase by 10%. And then the information that's included here, along with many other exhibits that support these numbers, are kind of proof as to why they need to increase those rates. And so remember I mentioned the permissible loss ratio. And so there's this number up here, this permissible loss and ALE ratio. What they're saying here is that they need to charge, they need half of their dollars, half of whatever they get in for premium is going to be needs to be available to pay out losses. The other half needs to go to other expenses. And the other expenses are listed over here on this side. And so you'll see they've listed commissions. So this particular company works with independent agents, and 19 cents of every dollar that they bring in goes to their agents as commission. Down below, there's, like I said, taxes, licenses, and fees are going to make up 1.5%. Other acquisitions and general expenses, 13.1%. Profit and contingencies, 10%. That's very standard in the homeowners market that they need. They are looking for, about 6-7% of that is for profit, and about 3 or 4% of that is for contingencies. The next line, where it says item 14 here, this reinsurance expense, that's becoming a bigger portion of the homeowner's costs. Reinsurance is insurance for insurance companies. This is to protect, homeowners carriers from major catastrophe events where, if we don't get a lot of hurricanes in the Northeast and New England, but if we did, it would cause quite a bit of, very euphemistically, it would be a headache for the insurance company if they're overexposed along the coast. And so, as an example. In other examples, there's wildfire issues, wildfire risk, and an insurance company is going to purchase reinsurance to protect them against large loss events happening at a time. These numbers, actually this 7.9% isn't as high as what I've seen for some other carriers, but it is ticking up. It had been in the low single digits for many years, and now it's becoming a bigger piece. It's just becoming more expensive for insurance companies. So then they add all that up, and they get this 51.8%, which allows them to then say, okay, well, we need to target a 48% loss ratio from actually paying out claims in order to maintain our business. And so that's what happens over here. They look to see how has what have we seen in losses in recent past, and they've noticed that, hey, our recent past, we've had a loss ratio of 60%. Okay, well, we have a permissible loss rate. We really can only afford to pay out 48%, and so that's where they get a raw indication of 24%. Right now, their experience is 24% higher than what they believe they can afford. But then they acknowledge the fact that New Hampshire is a small state. They don't have a lot of activity in New Hampshire. And so their particular data, their experience isn't perfectly credible. And it's a probability theory concept about credibility, where you need lots and lots of data to have it becomes more and more predictive. And if you have less than adequate data, less than a really large amount of data, then you really should balance those results against something else that you trust. And so what this company has done is said, okay, what we're going to do is we're going to account for what our experience is telling us at about 52%. We're about halfway confident with our own experience in New Hampshire, and we're going to balance that against just looking at nationwide trends, okay? And just say, okay, if we're just going to take loss trend and frequency trend alone, countrywide, then we would really only need about 6% over here. And so we're going to take the average of those two. And our indication is about 15.9%. About 16% is what we need to go forward. And then the insurance company, the management at the company says, okay, well, maybe we don't need to take all of that right away. Let's take something a little smaller so that policyholders don't get hit right away with all that if it's not necessary. And so they decide to do, and this is very, very common, to take, about 2/3 of what they say they need so that it's not so much of a hit to the market. And so generally speaking, this is kind of the approach that carriers take to develop and present their rate need. What we would do then is take a look at some of the homeowners rating factors. So these are pieces that differentiate what kind of the average or the overarching need for the carrier is, and then you're going to differentiate different homes, different situations, and different policies, similar to what we did for auto a few months back. The two big ones, coverage A amount. So if your home is more, coverage A is the cost to replace your home, to fix your home. If it's a total loss, then it's what it costs to rebuild your house. And the more expensive it costs to rebuild a house, the more you're going to pay for your homeowner's coverage. Building materials. If it's made out of brick or masonry, it's a lot less likely to have damage. The number one threat to homes in New Hampshire, of course, is fire. And so if you're built out of a wood frame, framing versus masonry really affects the costs of the coverage to the individual home. Age of the home and age condition of the roof it plays a role in pricing homeowners on an individual basis. Now, protection class code. Protection class code basically comes down to what kind of fire department do you have and how far is the fire department from your home. Again, fire is the number one threat to homes in New Hampshire, and this is going to be translated into protection class, which is produced at Verisk, which is the insurance services office. Prior paid claims. This is good if you've had recent claims in the past, usually more than one. If you've had one claim in the last 3 years, it's not going to have a significant or any effect on your home, your homeowner's policy. But if you've had 2 or 3 claims in the last 3 to 5 years, that is going to start to be an indication that there's more likely to have a future claim. Your insurance score. Some insurance carriers will use an insurance score for homeowners, not all, where I would say on the auto side that is much, much more prevalent, where I'd be hard-pressed to find a carrier that doesn't use, and this is a credit-based insurance score, very common in auto. I wouldn't say much less so, but there are some carriers that don't use it. Some carriers do on the homeowner side. Deductibles, of course, if you have a higher deductible, you're going to have a lower premium. And so what I thought we would do next is kind of look at some of the ways that a homeowner's policy you might be able to control some of those costs, or at least have, some way to mitigate some of those expenses. So we always recommend that you shop around for your insurance. This is something we do at the department and through consumer services quite a bit. Homeowners carriers will provide some discounts. They will provide discounts at new business. They will, like I said, they will provide a claims-free discount. If you haven't had claims in the last 3 to 5 years, they will give you a discount there. If you have like a security system in your home, or you have one of those companies that sets up your fire alarm system to trigger the fire department immediately if there's any sign of smoke or fire, most homeowners companies, homeowners carriers will give you a discount for that. Affiliations and packages, some insurance companies will work with various organizations like teachers groups or AARP or homeowners associations to give a discount in kind of like a group setting. Or if you package your policy, if you're working with the same agent and you package your policy, your homeowner's policy with an auto policy, or if you have an umbrella policy, you might get some discounts there. And then, of course, increasing deductibles will decrease your premium. So at that point, I thought we would stop and see if there's questions or if any of the other folks had comments there.
All right, well, we appreciate everyone joining us. Keith, James, any final thoughts?
No, this is again Keith Nyhan. I want to thank everybody for joining us. Christian did mention one particular fact that we do highly encourage consumers to do, which is to shop your insurance. In some cases there may be some rewards for consumers if you stay with the same company, and just as frequently, if not more frequently, there's not a lot of loyalty anymore. That if you do shop your insurance, chances are you can find cheaper rates elsewhere. But work with your existing agent. If you don't know how to find an agent, we certainly encourage you to reach out to find an independent agent who can help you. And on that note, I'd like to thank everybody for joining us today.
Yeah, put our consumer services information in the chat window. So if you need to reach out to us, call us or give us an email. Next month, we'll be giving a legislative update, so be sure to tune in for that. And as always, we appreciate you joining us. You can view past webinars on our YouTube page. Thanks so much.